Hi, welcome to Radical Markets. This is Galen. On today's episode, I'm going to be talking about price fixing. What is it and why is it bad? Okay, the type of price fixing I want to talk about today is price fixing by governments. So, price fixing is a solution that governments often turn to address the problem of high inflation. So, if there's a country where prices are going up all the time of basic goods, so rice, electricity, chicken, gasoline, those kind of goods are constantly going up in price and making the cost of living higher for everybody. The people in that country become upset, and actually they want it to stop, and they turn to their leaders to come up with a solution to their problem. And so often governments will fix prices at a certain level. So they'll make it illegal to raise prices beyond where they are or where they were a few months ago. They might set a price where it is today or lower. So you can imagine a country where the price of chicken was $5 a year ago. A year later, because of inflation, it's $10, and it's going up more and more every month. So a government might fix the price at $10 or even go backward to $7 and demand that all commercial stores only charge $7 for their chicken. That's the type of price fixing I would like to address today. So the problem with the government fixing a price at an artificially low level is that the increasing prices that are occurring in a country are usually happening for real market reasons. A lot of the time, the cause is monetary, so a country will be experiencing higher prices because the value of their currency is going down. So that could be because the government is printing a lot of money, and by increasing the amount of money in circulation, they're decreasing the value of each unit of that money. So like if a country has $100 trillion worth of pesos or whatever in circulation, and then they double that to 200 trillion, they're effectively cutting in half the value of their money by making it twice as common, reducing the scarcity of it. Other reasons can be just political. So like today in Greece, there's a really deep sense of distrust for the Greek government. So basically a radical left party came in, won an election, and basically started saying they were going to go back on all the promises that previous governments had made. So when you have like a radical political group come in and reject their responsibilities, say, oh, we're not going to pay our debt anymore, that decreases the trust in the currency by foreign investors and will reduce the demand for that currency in the global marketplace. Then there's also real reasons the monetary reasons are real, but reasons that have to do with the goods themselves. So if we're talking about chicken, there could be like a virus that kills off tons of chickens and drives the price of chickens really high. Or there could be like an oil crisis. There could be a shortage of oil, or Iran could like close off one of the straits of, I think Hormuz is the one that we're always talking about, and so the shipping lanes would be messed up, and the price of oil would go up, and that would drive the cost of a lot of goods to go up since everything's transported with oil, so on, so on. So often inflation is happening for a reason. And when governments come in and basically try to wish away that inflation by making it illegal to raise prices, they cause dislocations in the market. So they're basically they're trying to force market participants like grocery stores or whatever to sell their goods at a price that is not profitable. They want to force the grocery store to charge $7 when it costs $8 for the grocery store to get that chicken on the shelves. And that's when you start to see shortages, which is the biggest problem with price fixing. So creating a shortage is not usually what governments intend when they put in price controls. They're trying to make the price of a good lower in order to satisfy the demands of the people, but by doing so, they make it impossible for the providers of those goods to keep doing business and make a profit. And without making a profit, they're going to just bankrupt themselves eventually, so they'll just stop providing the good entirely. And that's what creates a shortage. The market participants have no reason to keep producing the good at the low price. And so governments basically have made a bad problem worse. Paying a higher percent of your income for basic goods like food is obviously not desirable, not a condition that any citizen wants to be in, but it's not as bad as not being able to get that good at all. So I hope you enjoyed this video about price fixing. If you have any questions or comments, please leave them below. If you enjoyed the video, like it and subscribe. I'm going to follow up on this video with a video about interest rates. And then in the video, I haven't decided if either in that video I'm going to cover two topics or if I'm going to break it up into two videos. But I'm definitely going to do interest rates next, and I might talk about how the US fixes the price of interest rates and how that creates problems in our economy. But yeah, hope you enjoyed the video, and I'll see you again next time. Bye.